Let's strip away the poetry for a moment. Markets love to dress themselves up as natural phenomena. Waves, cycles, seasons, gravity. It all sounds very elegant, very academic. But that framing is comforting fiction. In leveraged finance, prices don't move because of fate or vibes. They move because pressure builds somewhere in the system until something breaks. Markets move because someone is forced to act. Someone runs out of time. Someone runs out of money. Someone bleeds. And today we're talking about the purest, most mechanical form of financial pain there is, the margin call. Not the polite version, not the please top up your account email. We're talking about the margin call from hell, the kind that doesn't ask, doesn't negotiate, and doesn't care who you are or how many marble columns your headquarters has. This is about a very specific setup. Foreign banks sitting on roughly 215 million ounces of short silver exposure. Paper silver. Highly leveraged, perfectly legal, perfectly rational until it isn't. Picture a large European trading floor. Fluorescent lights, multiple languages, coffee that's been reheated too many times. On one wall is the P&L screen. It's supposed to flicker between green and red. Lately, it's just red. Deep red. The kind of red that doesn't blink anymore. It's been that way since December, right around the time JP Morgan quietly flipped long. This bank, call it Bank Euro, is short silver. Not because they hate silver, but because, for years, being short silver worked. Central banks were tight, volatility was manageable, and every spike faded. It was easy money, until suddenly it wasn't. They're short 215 million ounces. At $30 an ounce, that's about $6.5 billion in exposure. But they didn't post $6.5 billion, of course not. This is futures. This is leverage. On the COMEX, leverage can easily be 10 to 1, sometimes higher. So instead of $6.5 billion, maybe they posted $600 million in initial margin. That's the key detail. Everything that follows hinges on that. Leverage is wonderful on the way up. On the way down, it is merciless. At 10 to 1 leverage, a 10% move against you doesn't hurt. It annihilates you. Your equity goes to zero, and silver is not exactly known for gentle, well-mannered price action. 5% in an hour is not exotic. It's Tuesday. Every single trading day, after the market closes, the clearinghouse, the CME group, does a mark-to-market. No opinions, no narratives, just math. They look at where silver closed and calculate who owes what. If silver closes up $1 on the day, Bank Euro is down $1 times 215 million ounces. That's a $215 million loss in one day. And the clearinghouse doesn't care that tomorrow is another day or that volatility might calm down. They issue a variation margin call. Translation, wire us $215 million in US dollars by tomorrow morning, or we liquidate your position. No IOUs, no phone calls to old friends, no trust us. Now imagine this doesn't happen once. It happens 3 days in a row. Monday, silver up $1, down $215 million. Tuesday, silver up $1.50, down another $322 million Wednesday. Silver jumps $2, down $430 million. In 72 hours, nearly $1 billion in cash has been ripped out of the bank. Not accounting losses. Cash. Real money. The stuff banks actually need to breathe. Liquidity is oxygen. And when you drain $1 billion of oxygen that fast, people start to panic. The alarms go off. The Treasury desk starts making calls. The chief risk officer storms onto the trading floor with the subtlety of a fire alarm. He's not asking questions anymore. He's issuing orders. Close it. Close the position. Now. And that's when the trader looks up, calm in the most unsettling way possible, and says, I can't. Not won't. Can't. Because closing a short position means buying. To close 215 million ounces of silver, you have to buy 215 million ounces of silver. And here's the problem. Who is selling? The US banks are long. JP Morgan is long. They're not offering liquidity at $30. The miners are holding back supply. Physical holders aren't dumping into a rising market. The only real sellers left are high-frequency trading algorithms, and they don't sell cheap. They sell higher. If Bank Euro tries to buy even 10 million ounces to reduce risk, their own buying pushes the price up. That price increase immediately increases losses on the remaining 205 million ounces, still short. The harder they try to escape, the tighter the trap becomes. This is the liquidity paradox. In theory, you have a position. In practice, there's no exit. Meanwhile, the margin calls keep coming. And here's another detail people overlook. These are foreign banks. Their balance sheets are in euros or yen. Margin calls are in US dollars. That means currency swaps. That means FX markets. That means timing. If dollar liquidity tightens, or the dollar spikes, or funding markets hiccup even slightly, suddenly getting hundreds of millions of dollars overnight becomes complicated. Eventually, the call comes from Treasury. It's short, it's quiet, and it's fatal. We don't have the dollars. That's it. That's the line. No drama, no shouting. Just a statement of fact. When the funds don't arrive at the clearinghouse by the deadline, usually mid-morning, the process becomes automatic. There is no negotiation. The clearinghouse declares the member in default. This is the exact moment the human element is removed from the equation. The trader is done, badge deactivated, security involved, career effectively over before lunch. From this point on, a machine is in charge. The exchange's risk engine takes control. Its mandate is brutally simple: protect the exchange at all costs. It doesn't care about price stability. It doesn't care about optics. It doesn't care if this causes chaos. Its only job is to flatten the position immediately. Immediately means market order. A market order to buy 215 million ounces of silver. If you've never stared at an order book, here's what happens. At $30, there might be a handful of contracts for sale. At $30, 10, a few more. At $30, 50, slightly more, but this is visible liquidity. It's thin, always is. The risk engine starts buying. It consumes everything at $30 in milliseconds. Still needs millions of ounces. So it moves up. $30.10 gone, $30.50 gone, $31 gone, $32 gone. The book empties faster than a fire sale. There are gaps, no sellers in between. So the price doesn't walk, it jumps from $30 to $35 in seconds. On a chart, it's a vertical green line. To traders watching live, it looks like the screen is glitching. Now zoom out. Other banks are also short. They just watched silver jump $5 in a blink. Their margin requirements just exploded. They're getting their own calls. They're being forced to buy into a market that no longer has sellers at reasonable prices. This is the cascade. One default triggers another. Forced buying begets higher prices, which trigger more forced buying. It's a self-feeding loop, a financial chain reaction with no off switch. And standing comfortably on the other side of this chaos is JP Morgan. Net long, calm, profitable. As silver teleports higher, their account swells by billions. They become the liquidity at $35, $40, $50, selling into panic at maximum advantage. This isn't conspiracy, it's mechanics. This is how leveraged markets are designed to work. The margin call is the predator. It hunts weakness. It doesn't discriminate, but it is very efficient. And when the setup is right, when leverage is high and liquidity is thin, the result isn't volatility, it's extinction. What people often miss is that none of this is emotional, mystical, or driven by crowd psychology in the way movies like to portray it. At its core, this kind of event is simply math colliding with structure. When a massively concentrated position is forced to unwind inside a market that cannot absorb it, the outcome is not debate, it's a mathematical certainty. We've already seen this movie before. In 2022, nickel didn't gradually rise or politely trend higher. It detonated. Prices doubled in hours because one extremely large player, a Chinese industrial tycoon, received a margin call he couldn't meet. At that moment, it stopped being his problem and became the exchange's problem. The computer took control, and the market did what markets do when liquidity disappears. Silver sits in a dangerous middle ground. It's much smaller than currency markets, so it can't hide stress, but it's larger and more financially embedded than something like nickel. That alone would make it volatile. What turns it into a powder keg is concentration. Roughly 215 million ounces of short exposure are clustered in a surprisingly small number of hands. That's not diversification. That's a single point of failure. When the phone rings at a major institution like Deutsche Bank, Barclays, or Scotia, it won't just be another rough trading day. It will mark the end of a multi-decade regime. It's the moment when a paper-based suppression structure collapses under its own leverage. Ironically, one of the most powerful people in this entire story isn't a CEO or a hedge fund legend. It's a margin clerk at the CME. Not because he's a mastermind, but because his job is binary. Funds arrive on time, or liquidation begins. His finger hovering over that button carries more consequence than any market commentary on television. And all it takes is one more dollar move in silver to force his hand. We've already walked through the trigger, the default itself. Now we need to talk about the environment it explodes into, because context determines magnitude. In a healthy, normal market, buyers and sellers coexist at every level. Liquidity cushions price movement. Trades happen tick by tick, step by step. But this is not a normal market. This is a post-suppression market. For years, the silver order book was artificially thick. Large U.S. banks flooded the sell side with massive orders they never intended to execute. Spoofing, layering, whatever term you prefer. The effect was the same. It created the illusion of endless supply. Look at all those sellers at $30, $30, $50, $3,100. Don't worry, plenty of silver available. Except it wasn't real. And now that those same banks are net long, those phantom sell orders have vanished. What's left is a hollow order book. Thin, brittle. Above the current price, resistance barely exists. This is what traders mean by a vacuum. And firing a forced liquidation into a vacuum is like launching a cannonball in space. There's nothing to slow it down. Let's visualize what actually happens inside the exchange. The order matching engine, the brain of the comics, exists for one purpose: pair buyers and sellers. It doesn't care why they're trading. It doesn't ask questions. When a forced buy order for 215 million ounces hits that engine, it simply starts searching. Are there sellers at $30? Yes. A few. Done. How about $30.50? Maybe a handful. Done. Anyone at $31? Silence. 32? A small hedge fund offers 5 contracts. Sold. 35? One market maker blinks. Sold. And suddenly you see it. The price isn't moving smoothly, it's jumping. This is what a gap really is. The market isn't choosing to skip prices. Those prices simply don't exist. There are no willing sellers there. In a true super spike, the ticker tape might print 30.05, 30.50, 32.10, 38 or 45 word in seconds. No trading in between, just teleportation. On a chart, it creates a single candle that looks almost fake. A massive green rectangle with no wicks, covering $10 or $20 in 1 minute. Traders love to analyze charts, but in moments like this, the chart is just an autopsy photo. Why are there no sellers? Because every natural seller has stepped aside. The banks are long and want higher prices. Physical holders aren't parting with metal at any price that still feels cheap. Miners know what replacement cost looks like and are waiting for fair value. The algorithms, those same high-frequency systems that used to fade rallies, have flipped into trend-following mode. Buy strength, chase momentum. So the risk engine is essentially shouting buy into an empty room. This is where slippage becomes monstrous. Slippage is the difference between the price you expect and the price you actually get. In normal markets, it's measured in cents. In forced liquidations, it's measured in disbelief. The computer doesn't care if it's paying $50 for silver that traded at $30 60 seconds ago. It has one mandate: close the position. Cost is irrelevant. Eventually, the exchange's circuit breakers kick in. These exist to prevent total disorder. If the price moves too far, too fast, trading halts. Limit up. 15 minutes of silence. Screens freeze, traders stare, heart rates spike. Somewhere, a compliance officer wipes sweat off his keyboard. Those 15 minutes are supposed to restore order. In reality, they're just a pause before the next wave. Foreign banks use that time to scramble for liquidity. Calls go out to central banks, to counterparties, to anyone who might help. But 15 minutes isn't enough time to raise hundreds of billions of dollars in emergency funding. When trading resumes, nothing has changed. The risk engine is still active. It still has tens or hundreds of millions of ounces left to buy. And immediately, bang, the price gaps again. Another limit up. Trading halts again. You can easily envision a day where silver's locked, limit up. No buying, no selling. Just a posted price at the maximum allowable move while a mountain of unfilled buy orders grows beneath the surface. This isn't a bidless market. It's an offerless one. And for a short seller, this is existential horror. You are trapped. There is no exit. Your losses are theoretical only in the sense that no trade has printed yet. Economically, you are already dead. Now layer in the options market. As silver blasts through $35, $40, $45, option market makers face their own problem. Calls go deep in the money. Gamma explodes. To remain hedged, dealers must buy the underlying asset. So now you have multiple automated systems competing for the same non-existent liquidity. The exchange's risk engine, the options dealers' hedging engines, and trend-following algorithms are all bidding against each other. This is a feedback loop of pure instability. Price rises, margin calls trigger, forced buying increases. Price rises further, option hedging kicks in, forced buying increases again. There is no damping mechanism. Normally, profit-taking would cool things down. But who takes profit at $40 when they know a major bank is mid-collapse? Nobody. Liquidity providers pull their offers higher. Sellers start dictating terms. Oh, you need to buy? My price just doubled. The power dynamic flips completely. The buyer is forced, the seller is optional. That asymmetry drives vertical price movement. This is why $10 or $20 daily moves are not fantasy. In 1980, during the Hunt Brothers squeeze, silver moved $4, $5, $6 in a day when the price was around $20. Percentage-wise, that was enormous. Today, with algorithmic execution and machine speed trading, the same repricing happens not over days, but in milliseconds. The vacuum didn't appear overnight. It's the result of 4 decades of hollowing out supply. There's no meaningful buffer stock, no strategic reserve waiting in the wings, just vaults. And those vaults are far emptier than the paper claims suggest. So when the margin call finally hits, it slams into a market with zero elasticity. That's how you get a super spike. A vertical line that doesn't just move price, it resets it. And the most important part is what happens afterward. Once silver gaps to $50 or $60, it doesn't politely drift back down. The shorts are gone. The suppression capital is gone. The new price becomes the floor. From that point forward, the market is no longer asking what silver should be worth in theory. It's asking a much simpler, harsher question. What price is high enough to convince someone to actually sell? And the answer to that question is far higher than most people are prepared for. We've already seen the bank fail. We've already seen the risk engine light the fuse. What follows isn't chaos, it's repricing, and it happens faster than anyone thinks. Up to this point, we focused on the explosion itself. Now it's time to look at the damage left behind, the part most people never think about until it's too late. Because when a major short position detonates, the blast doesn't stop at the trader's desk or even at the bank. It travels straight into the plumbing of the financial system, right to the Central Counterparty Clearinghouse, the CCP. The COMEX, part of the CME group, sits in the middle of every futures trade. It guarantees performance. If Bank A blows up, Bank B still gets paid. That's the promise. That's what keeps traders confident that the system won't collapse just because one participant makes a catastrophic bet. But here's the uncomfortable truth. The CCP is not infinite. It's not divine. It's not a bottomless pit of money. It has limits. Those limits come in the form of the default fund, sometimes called the guarantee fund. This is essentially the industry's insurance pool. Every clearing member contributes. JP Morgan, Citi, Goldman Sachs, and yes, the foreign banks too. The idea is simple. If one member fails, the fund absorbs the shock and prevents contagion. Works great, until the losses are too big. Now imagine this scenario. The foreign banks default on a 215 million ounce short position. Silver has exploded higher. The total loss is $5 billion. The CME immediately seizes the collateral posted by the defaulting banks, but leverage cuts both ways. That collateral doesn't come close to covering the damage. Maybe the exchange recovers $2 billion. That still leaves a $3 billion hole. So who fills the hole? The default fund? And who owns the default fund? The other banks, especially the US banks who are net long silver. This is where the story gets darkly ironic. JP Morgan is making billions on its long silver position as prices explode upward, but at the same time, it's being asked to help pay for the losses of the very institutions it just steamrolled. This isn't a crisis. It's a civil war inside the clearinghouse. You can already hear the arguments. JP Morgan says, why should we pay for their reckless leverage? The exchange responds, those are the rules you agreed to. Lawyers start sharpening pencils. Risk committees stop sleeping. And buried deep inside the CME rulebook are clauses that rarely see daylight. Emergency powers, force majeure, liquidation-only trading, forced cash settlement at an exchange-declared price. These are the nuclear options, and we've seen them used before. In 2022, when nickel went vertical on the London Metal Exchange, prices briefly touched levels that would have wiped out half the brokers in London. The exchange panicked. They didn't manage volatility. They erased it. Trades were canceled. The clock was rewound. 8 hours of market history were declared invalid. Winners were told politely that their profits no longer existed. So the obvious question is, would they try that with silver? They might try. But silver is not nickel. In nickel, it was one Chinese industrial tycoon on one side and a collection of banks on the other. Easy political math. In silver, the alignment is very different. Major US banks are long, foreign banks are short. Canceling trades wouldn't restore order. It would confiscate billions of dollars from JP Morgan and hand it back to failing foreign institutions. And here's the part that doesn't get discussed on television. Do you think Jamie Dimon is going to quietly accept the cancellation of what amounts to a winning lottery ticket? No. The US banks have the leverage, financial, political, regulatory. If anyone is getting sacrificed, it won't be them. So the exchange is trapped. Let the trades stand, and the default fund risks being overwhelmed. Cancel the trades, and you ignite a war with the most powerful financial institutions on Earth. This paralysis is how systemic contagion begins. Because once traders start questioning whether the CME can settle silver, they immediately ask the next question. Can it settle gold? Can it settle equity index futures? Can it settle anything? Trust evaporates fast when the plumbing starts leaking. This is the point where the Federal Reserve enters the conversation, usually quietly, usually through a side door, a backstop, a temporary liquidity facility, $10 billion printed and lent to the clearinghouse to plug the hole. Officially, it's about market stability. Unofficially, it's confirmation that the system cannot survive without intervention. And that confirmation matters, because when a central bank has to print money to cover the consequences of a supposedly free market, it sends a very loud message. The currency is being sacrificed to preserve the structure. During those 2 or 3 days of chaos, the silver market itself may effectively break. You'll see prices on screens, but you won't be able to trade them. Dealers will pull physical inventory. Market closed until further notice. This is the unobtainium phase. Paper silver and physical silver decouple completely. The exchange might freeze the futures price at $50. Meanwhile, in the real world, silver eagles trade for $150. Junk silver disappears. Bars are allocated only to industrial customers. This is when everyone finally realizes the uncomfortable math. There were hundreds of paper claims for every real ounce. When the default hits, most claim holders get cash, maybe. One claim holder gets metal. The rest get a settlement statement and a lesson. The clearinghouse is the last line of defense. When it buckles, we enter a new monetary chapter. The rule of law in markets is tested. If rules are changed to save the shorts, global faith in U.S. markets takes a permanent hit. If the shorts are allowed to fail, the system resets, painfully but honestly. Based on positioning alone, the decision is already made. The foreign banks are expendable, the U.S. banks are prepared, they're wearing the blast suits. The mechanics of clearing ensure that the pain is fast and concentrated. Variation margin calls beat like a drum. Pay, 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 default. And when the default hits, the super spike is the mushroom cloud. That vertical green line isn't speculation, it's evidence. Evidence that leverage finally met reality. So the dust settles. Silver touched $70, maybe $80, maybe briefly kissed $100 in a blow-off move before stabilizing. The foreign banks are gone, liquidated, nationalized, or absorbed. The clearinghouse survives thanks to a discreet rescue, and the world wakes up to a very different market. Silver is no longer $30. The anchor is gone. The 215 million ounces of paper shorts that crushed the price for years have been bought back and erased. A new floor forms. Maybe it's $60, maybe it's $75. Volatility remains, but the old price regime is dead. You don't unsee a super spike. You don't put that genie back in the bottle. Psychology shifts overnight. Miners realize they have leverage and stop selling forward at giveaway prices. Industrial buyers, Samsung, Tesla, Apple, suddenly care more about supply security than cost. They start bidding against each other for stockpiles. The headlines scream silver triggers banking crisis, and global FOMO kicks in. People who never cared about metals start asking where to buy. This is the transition from a managed market to a free one. In a free market, price is set by the marginal buyer. And in this environment, the marginal buyer is desperate. The margin call from hell wasn't chaos, it was purification. It burned away manipulation. It burned away naked shorts. What's left is price discovery. And the truth that emerges is uncomfortable for paper traders, but obvious to anyone holding metal. Silver is scarce, silver is strategic, and silver is money. For those who held through the spike, the reward isn't just financial. The asset itself has been de-risked. Suppression risk is gone because the suppressors are gone. Ironically, the same U.S. banks that once leaned on the price are now incentivized to promote higher prices. Watch the narrative flip. Goldman issues $200 price targets. CNBC runs specials on the silver century. Ownership changed, so the story changes. The super spike is the transfer mechanism. It transfers silver from weak hands to strong ones, from leveraged promises to physical reality, from fiat illusion to hard asset truth. At the end of the day, all this complexity boils down to one word: insolvency. The shorts owed metal they didn't have and money they couldn't raise. The exchange machinery, the risk engines, margin calls, default funds didn't create the problem. They simply processed it. So when you see silver jump $5 in a minute, don't ask why. You already know. It's the computer. It's the margin call. It's liquidation doing exactly what it was designed to do. Sit back, watch the green line go vertical. Every tick higher is another shackle breaking off the silver market. The guards are broke, the gates are open. This isn't speculation, it's math. The phone is ringing in Europe, and this time they can't pay the bill.